So hello traders and potential future traders, Patrick Maldonado here, cryptocurrency trader and market analyst at Alpha Chain Capital and creator of TCE Trading. So in today's episode, I will be talking more about the importance of having a trading plan. You might have heard that if you fail to plan, you are really planning to fail. Planning is essential in trading and even more so when challenging emotions and uncertainty. If you would like to start learning how to trade, get a 70+% discount with the code TCE Friends on my AV trading course in Udemy. So traders, hello once again. Let's talk about the importance of having a trading plan. And this is something very important, as I mentioned before. If you fail to plan, you are kind of planning to fail, and this sounds very harsh. To be honest, it sounds very harsh that you are saying that someone is planning to fail, but there's an importance. It's very important to have this into consideration. But let's just kind of reflect a little bit. Why would you want to plan something out when the market does whatever it wants to do, right? And I have been talking about the fundamental truths of trading before, so you know that the market does whatever the market wants to do. So why would you even think about planning when in the end the market is gonna do whatever it wants to do? Well, if you think about it, the plan is not really for the market. The plan is for you. The plan is for you to take into consideration your stop losses, your take profits, when to enter, when to exit, how to react, what to do in uncertain situations. So the plan is for you, not for the market. So that's why it's so important to have a trading plan. Now, there's a very, very important difference between what's called mechanical traders and what's called discretionary traders. And I have not talked about this before, not even in the AV trading course. I do cover some parts indirectly, but this is kind of like a definition that's important. So mechanical traders are the ones that only use indicators and based on different, I don't want to say patterns, but based on different triggers, they will take a trade and they will execute a stop loss or a take profit, and then that's it. It's all mechanical. It's do this and do that. Now, on the other side, discretionary traders are the ones that say, hey, I feel that the market might go down, and they go back, they short into the market, and then maybe potentially they think that support or resistance might not hold, and discretionary, they say, I'm still gonna hold this position until it breaks, and if it breaks, good. If it doesn't break, well, maybe they break even or whatever. Now, in my opinion, I think the best approach is being something in the middle, right? You don't want to be all mechanical, because sometimes the market, might be more volatile and you have to adjust. But you don't want to be all discretionary, because if you don't have kind of like a trading strategy or something to follow, then you might just be in the uncertainty. You might just be at the will of emotions, because you don't know what's going to happen and you don't really have a plan. Now, in terms of your trading plan, what should it include and why? So first of all, again, this is something that I discussed in the AV trading course, but it's something, very basic that I'm just going to briefly cover in here. You want to include your indicators. You want to include your entries and exits. Why indicators? Because you need to think, okay, what am I gonna be using in order to focus in the market, right? If you don't write which indicators are you using, maybe you have 10, maybe you have 20, and you're not gonna be focused on all of them. But if you actually write maybe a few of them, you are really gonna be focusing on what they have to tell you. Now, entries and exit, again, specifications. Maybe your entry is gonna be like when the price is doing a divergence with the RSI oversold, stochastic oversold. I'm gonna enter a trade short, let's say, and exit at this point in time. That's just pretty basic. These rules are really for you to follow. Now, the important part as well is that you need to line up your risk management rules, and in the last episode we talked about the risk management. So this is where you're gonna be saying, okay, I'm gonna risk 1% per trade, and I'm gonna have a daily drawdown, maximum drawdown of maybe 5%, and then a weekly or a monthly drawdown of, let's say, 10%. That's really up to you. Again, these are just guidelines. You do yourself, you do what you do, what you think is better, but it's kind of like, it's best practices in order to at the very least have something written and know what to do. Also, things that you might want to include is time frames, assets. You want to be sure that you are going to be trading a specific market rather than trying to hit all of them, because with all the financial news, with all what's happening in the current economy, you never know. It's better to focus only on, maybe 1, 2, 3, 4, even 5 assets, but in the same market. Again, you can diversify, and if you diversify, it's perfect, but just take that into consideration that it might also affect you. No, as well, market conditions, very important. It's not the same trading in a trending market than trading in a choppy market, in a consolidation market. This is important because depending on your strategy, of course, it might perform better in different markets. And if you have this into consideration in your trading plan, this might benefit you. Now, another thing that you want to do with your trading plan, and what's most important, is really to avoid cognitive biases and tilts. So I go again more deeply into the course. I'm not really going to be covering them, but you might like to add, for instance, psychological reactions. Let's say that if you have 3 consecutive losses in your trading plan, you write down that if I have 3 consecutive losses, I'm gonna stop trading. And maybe you're angry, maybe you're mad at that point in time, but maybe you'll have to suck it up. You'll have to go and take a walk. I don't know, maybe do some exercise in order to calm down. The point is that you can also write these type of things in your trading plan, so that if it happens, you know what to do. Another example is if something unpredicted goes wrong, maybe just stop trading. I'm gonna give a brief personal example in a moment, but if something doesn't go according to your plan, then just stop everything. Put the plug out, because if not, things might get worse. Also, another thing, conditions for re-entry. Maybe you lose a trade and you want to re-enter. So are you going to have specific rules for that? Maybe you want to wait 2 or 3 times your risk in the opposite side to re-enter, or maybe when the indicators show a specific signal, then you are just going to re-enter, because if not, you might be subject of just losing a trade and being like, oh, I lost this trade, but I'm pretty sure that this is gonna be a winner after. So you re-enter, and then it's just like you were expanding that stop loss and adding more risk rather than just follow your initial setup. Now, something very important is that this is also gonna help you to manage uncertainty. And what do I mean manage uncertainty? I've talked about the fundamentals truths of trading. Is that your plan is basically an action guideline, right, of what to do. Your plan is writing down the potential scenarios and what are you gonna do in those scenarios. Now, I'm gonna talk more about back testing in the next episode. I'm gonna give you some key gold nuggets for you and your trading. But it's important that you know your edge and probabilities, and you take this into consideration when talking about your trading plan, because if you already know your trading edge, maybe you already know that your specific strategy is about 50% correct, and the average risk reward ratio is of 1 to 2. You know that you're gonna be profitable in the future. So that's how you manage uncertainty, and that's how, again, you can put it in your trading plan. Because if you know that you're right 50% of the time, maybe even if you have 2 or 3 consecutive losses, you know that in the long run, as long as you have a correct a good risk management, you're gonna be profitable. You just have to be patient, and you just have to follow your trading plan. I wanted to talk about a personal example that happened to me, I think a couple months ago, probably. I'm not quite sure. I don't remember exactly when it happened, but it's important because it actually happened twice. Now, what happened with my trading is that I was trading on Binance and I was using a stop limit orders. Now, this might be a lot of jargon, and this might be very technical, so I don't really want to explain exactly what happened. But the point is that when you use this type of stop loss orders, let's call it like that, which is called stop limit, you are basically allowing a threshold where you want to get out from the market. So if in the market it's very volatile, there's not a lot of orders, and people are just buying and not selling, or vice versa, depending on your position, there's the possibility that the market moves so fast that it does not trigger your stop loss. So that's something that happened to me. That's also a reason why I moved from stop limit into stop market, because if something happens, I just want to get out of the market. If the price is really going against me, I don't even want to minimize the cost. I just want to make sure that I'm gonna be out of the market. So this is something that happened, that my stop loss did not work. Now, in retrospective, when that happened, I did not know what to do. I tried to solve the issue, but of course, when you are uncertain, that's where cognitive biases and tilts, get you. That's when they really clouded my mind. In that particular example, instead of just disconnecting, taking the plug out, and just saying, okay, you just accept it, this didn't happen, you lost a little bit more, but that's it. I tried to solve it, and to be honest, I would have been better just by cutting that trade. Take my losers and be like, okay, this was an accident. Let's talk about it another day, instead of just trying to work it out, saying, okay, I'll increase my risk, I'm gonna do this, I'm gonna try to see if I can come back, because this is an uncertain scenario that might happen. It doesn't, you don't have to think that it's gonna happen, but it might happen, and you would need to have a plan. Now, for me, this is why I even said before, if something that I was not taking in consideration happens, it's something that unacquainted, that I was not sure that could be possible, but for some reason it happened, I'm just gonna close all the trades. I'm just gonna close, I'm gonna take my losses, I'm gonna reevaluate, because that's when cognitive biases get you. But in any case, traders and listeners, I hope that you enjoyed this episode of the TCE Trading podcast. Remember to never fail to plan. You will see a huge improvement in your trading if you know what to do before good or even bad things happen. If you like my content, I would like to ask you if you can please share it, as it really helps me grow the podcast and help traders who might be struggling, or people interested in having a secondary income, learning a new skill. It's not really only about selling, the course or whatever. It's really kind of my purpose to reach more people. That's why I do some free content as well. But in any case, thank you very much for listening, and I will see you in the next episode. Take care.